Right, good afternoon. It's Sunday the 17th of April, and this is the Stage Analysis Members Weekend video. As always today, we're going to start with a look through the major indexes before going into some detail on what's been going on in the market breadth indicators in order to try and determine the overall weight of evidence, which is a key part of Stan Weinstein's Stage Analysis method. And then go on to the industry groups in focus, have a look at the industry group relative strength tables and see which groups have been coming up the most in the watch list stocks before actually going into more detail and seeing what's going on with the weekend watch list stocks. So that will be later in the video. So first section is just for everybody, and then once we get into the market breadth section, it's for members only. So if you're a member, remember to log in before this point, because otherwise it will bug out about 10 minutes into the video. But obviously non-members, you can view this first 10 minutes or so as a free preview. So I hope you enjoy. Okay, let's begin. So starting off today, we're going to look at the S&P 500. So normally look at this, the Nasdaq Composite, Russell 2000, potentially a few other major indexes. But we'll start with the S&P 500. It was a very choppy week. We ended up closing the week below the 50-day moving average again after failing for a second time at the 21-day moving average here. You can see declining 21-day, and we're still below that 200-day moving average. So still around 2% below the 200-day moving average here in the S&P 500, and within this broader trading range that we've been in since that January the 24th initial local selling climax. You can see I've marked up the distributional patterns using the Wyckoff markup on here. So we had the original topping pattern up here, and then this secondary base that we've been forming down here, which obviously we're still trying to determine whether it's an accumulation base or a redistributional base at the moment. At the moment, my ideal for this at the moment would be to wash out a little bit, potentially some spring type action at the bottom of the range, then come back in and up back into the range again. So that would give us some potential actionable areas to start considering again. But obviously it could still hold up, and we could still test the upper part of this resistance zone again. This is our major resistance area that it's been in for many months, and very similar to what we see in the Nasdaq, which I'll show you in a minute. Percentage of S&P 500 stocks above the 20-day moving average is around mid-range at the moment. 49% stocks are above their short-term moving averages, so very much in the middle of the range, in the middle of actual stocks above their short-term moving averages. So very sort of neutral area, but it does look a little bit on the weak side currently. So in order to determine short-term trend, you drop down to the lower time frame. As you can see on the lower time frame, you can use stage analysis on the lower time frame as well as on the daily and the weekly time frames. It works best, I find, for the intraday for swing trading purposes on a 2-hour chart. You can use it on a 1 hour and a 30-minute as well, but the stages and the weekly settings with the same relative settings as the weekly chart, I've found over time work best on a 2-hour chart for determining the stages. So in terms of this is the Spider S&P 500 ETF. So I've marked up the stages on here, and you can see we're currently in a stage 4 downtrend on the intraday chart. So, which obviously in our daily chart we're in the middle of the range, sort of going sideways. So this helps us in terms of short-term trend to determine whether we should be long, short, or neutral. So at the moment, this is saying we're still in the stage 4 decline. So until this starts to firm up into a stage 1 base or starts to reverse back up into stage 2, then we're obviously on a difficult environment. So trying to stay away from the long side at this point. Nasdaq Composite, we had that engulfing candle on Friday after looks like an engulfing candle on Thursday, so really choppy action, lower volume at the end of the day. But you can see relative strength versus the S&P 500 here at the bottom, still pretty close to the lows. Still a big level up to its zero line here. So this is the zero line, which is the 52-week moving average of the index versus the S&P 500. So this on the original Mansfield relative strength chart would have been a flat line, but obviously in stock charts here, we use it as the MA itself, and it does give you additional information if you use it as the moving average based on the slope of the moving average. So when it's downtrending, obviously it's negative. When it's uptrending, it's more positive. So you want to be above. You want this line to be above an uptrending zero line. So at the moment, we're still a long way below the downtrending zero line in the Nasdaq. So the Nasdaq remains weak. We're still below the 50-day moving average and the 21, and this major resistance area that's formed over the last year, where we've had multiple tests on the upside and the downside to form this major support resistance kind of area around the 14,200 level. So in order to get more interested on the long side again, we want to see it start to get back above that level and start to hold back above there again. And obviously, we've still got a long way to get back up to the 200-day moving average in the Nasdaq, around 10% currently. So S&P 500 relatively outperforming by a long way, as it's only a few percent in the S&P 500. Look at the Russell 2000. You see that also failed at the short term and the medium term on Friday. So 21-day and 50-day moving averages in there. Not an engulfing candle like we saw on the Nasdaq Composite, the S&P 500 there, but still weak nonetheless, down almost 1%. But again, still within the middle of the range, so continuing to form a sideways range. Again, underperforming the S&P 500 relatively. So large caps still in favour, and this, as we know, is still in stage 4 here. So we had stage 4 breakdown around this level here. Go to the weekly chart, you can see the broader structure that's formed over time. We broke down into stage 4 here, and we're continuing obviously to form this secondary base underneath in early stage 4. So potentially we could break down off to stage 4 if things get really bad. But in terms of in more positive outlook would be for a return back into the range. So we start to see this kind of behavior get back into the range, back above that 30-week moving average, and it starts to turn back up, then obviously that would be much more positive for the small caps and the market in general. But as you can see, as I said, we've still got a big gap here between the zero line and the relative strength line. So Russell 2000 still continuing to outperform. And as you can see previously, best time to be in the small caps is when we are above that zero line and the zero line is flattening or turning up. So from November through to March 21, which if we have a look at that period there on the chart, you can see that was our strong period when it was above. So until it started to break back below again, this was the time to be in the small caps between November and June last year. But at the moment, it's been underperforming since this point here. So you can see it's been well below throughout that entire time, and small caps has underperformed for the vast majority of that time, except for a brief pop where it formed that up thrust after distribution here, which, as you can see on the chart, this was our little up thrust area before the last point of supply, breaking down in stage 3 before we actually broke down into stage 4 around this area here. So Russell continues to look weak, but it has firmed up a little bit and made a higher low of late. So relative to the Nasdaq Composite, it's looking reasonable, but still one of the weaker areas of the market. Moving on, I just wanted to highlight a few of the large cap stocks at the moment. So a few of the mega caps, as obviously they make up a large percentage of the Nasdaq 100. For example, we've got around 10 stocks make up 50 to 51% of the Nasdaq 100. So, and of those, we've got like Apple, Microsoft, Google's, Cisco's, etc. So Amazon, they are, if what they're doing obviously gives you a good guide of what's going on in the market. So Apple, one of the strongest at the moment still. You can see still above a rising zero line down here on the weekly chart, still above its 30-week moving average, although we did get a close back below that 10-week moving average there this week. So forming a stage 3 base, but still holding above the 30-week moving average, which is still rising at the moment. So Apple still looking reasonably strong, whereas Google, on the other hand, you can see this stage 3 range that's been developing since this change of behavior over here. So we had from the up thrust up here, we had a change of behavior as it started to break down into stage 3 here. You can see I've marked up the broader range on this. So the change to stage 3 doesn't happen until you get an initial change of behavior. So we can see these swings here. So you've got normal range swings in here, no change of behavior until this point. But at this point here, you can see there was a change of behavior. So that's when we start to move into stage 3, once we start to see that kind of behavior. So at this point in here, you move from stage 2B. There's obviously late when you're in stage 2. Late in stage 2 is called stage 2B. So we were in stage 2, we got into late stage 2B up here, and then we started to move into stage 3. But the thing with stage 3 is obviously the base structure can start developing before you know that you're in stage 3. So you can see you can start marking your actual range from earlier back in here. So sometimes you don't know you're in stage 3 until the very last point of the base structure. So you might not get the change of behavior until you've had an up thrust after distribution. So if you imagine you're in a stage 2 uptrend, you're moving up, and then you form a head and shoulders type pattern, you don't know until this point here, this is your change of behavior, that you're in stage 3, and then at that point you're then going down head and shoulders pattern. But as you can see, you've got the entire stage 3 base sort of structure actually started much earlier when you were still in late stage 2, but you don't know you're in stage 3 until this point here. So that's one of the common misconceptions with stage analysis is how to identify stage 3. So look for that change of behavior, and in Google's case here, we had that change of behavior at this point in here at the start of the year. So you see it started to get more volatile, and then we started to go sideways in this range. If we look at it on the daily chart here, you can see the first a good guide of how to mark the stage 4 range, where the stage 4 breakdown level is to look for the first swing low that occurs under the 200-day moving average when that's still rising. That's a good starting point for identifying the bottom of the stage 3 range. So you can see here we've got with Google, we've got our basic stage 3 range forming in here. So looking for, in order for it to move down into stage 4, you're looking for a break down below the bottom of the range here. So if I go back to the weekly chart, you can see at the moment it's getting into, you can see the 30-week moving average has just started to roll over in the last few weeks, so it's definitely in the danger zone. And at the same time, you can see the relative strength versus the S&P 500 has broken below the zero line. So again, this blue line here is what we call the zero line. It's the Mansfield RS zero line. So it's the 52-week moving average of the stock versus the S&P 500. So when the stock starts to break below that, it's another way you can tell that you're in stage 3. As often you don't break below that after you've been in above that line for a long time, as you generally don't move below that when you're in stage 2. Once you start to move but above and below that, you tend to be in stage 3. And then potentially, if we start, as I said, if we start to move down below here, you could potentially, that would be a stage 4 breakdown, and then you could potentially have that kind of behavior. However, stage 4 breakdown level is what we call a pivotal point. So I think it's what Jesse Livermore originally coined as the pivotal point. Basically, it's an area where we get a confluence of a large amount of buyers and sellers fighting it out. So it's a good test of whether there's still demand at this point. So if we do get a test of the low here, obviously sometimes you can get, quite often in fact, you can get what we call a Wyckoff spring, and then you can start to come back in and then have a higher low test and start to move back into the range. So if there is demand still, then you should start to see it at this point, and you should start to see it around this point of basically once it's washed out the weak hands. However, as we know, you can also just as easily break down and then go all the way, move into stage 4. So it's what we call the pivotal point. So this area in here, I keep doing the wrong one. This area in here is the pivotal focus in the next week. So 2,500 kind of range on Google. Microsoft in a very similar position, shorter base structure, but again, as I was saying before, you don't know you're in stage 3 until you get this change of behavior. So you can see we've had change of behavior here with this bigger pullback compared to these previous swings. You can see the swings were much smaller until this point here. So you now know you've started to move into stage 3. You can see we've got a bit of a head and shoulders type pattern that's been developing. in here in the broader thing. So we've got a fairly big stage 3 range, even though, as I said, until this point, you don't know that until you've actually got a bigger swing, you don't know you're in stage 3. So, for example, if you before this area started to form, this area here, you're still in stage 2 at this point. Once you start getting that change of behavior, you then know to mark this as stage 3. So again, this is potentially going to make a stage 4 breakdown attempt. If it does, if it manages to break down, then obviously you'd expect this kind of action. But obviously, if we start to see some kind of spring type action in here and it moves back up into the range, then that would be a potential bullish event. So it's a pivotal week for 2 major stocks there. Amazon's already in stage 4, broke down a while ago. It's been making this flag type pattern, so potential bear flag at the moment in this. If it breaks to the downside here, then would just be off to the downside in stage 4. But if it can continue to hold this range and we can see a move back up into above the 30-week moving average, and that can start turning back up, then that would obviously be a positive. So at the moment, again, in the danger zone. So we've got a few major stocks in the danger zone, including Cisco here, making a stage 4 breakdown attempt this week with a close at the bottom of the range. Still hasn't completely broken everything. We've still got a little bit of support from this previous area here. But you can see the 30-week moving average is rolling over, and it is attempting to break down to stage 4 with relative strength below the 0 line. Again, with this one in here, you didn't know you're in stage 3 realistically until this kind of point here, until you have this major change of behavior. So, and again, we've got this head and shoulders type pattern that's been developing on this one. So lots of the major stocks here continuing to look weak, but they are at pivotal points. So it's going to be an interesting week for sure. Okay, right, that's the end of the free content for today. So moving on, we're going to move on next into the market breadth. So again, if you remember and you haven't logged in already, then you're about to get the splash screen with the login bar. But otherwise, if you're a non-member and you've enjoyed this content so far, coming up next, we're going to have the market breadth. We've got the industry group relative strength, and then we're going through the watch list stocks. So I do this twice a week, a bit different on the midweek one, go through some shorter term trends and shorter term market breadth stuff and what's been going on in the watch list and the group themes in the watch list during the week. So it's a little bit briefer than the weekend video, but generally follow the similar sort of pattern, but much more short term focused on the midweek one. So okay, moving on.